In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about results of 5 different FMCG players in order to understand a little deeply as to what exactly is happening in the FMCG space and what is there for us as investors and as analysts. And in the second story of the day, I'll talk about why Volkswagen is suing India and what's really happening there for people like you and me. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for you to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 5th of February. With that, let's begin with the first story. It's the result season right now, and almost all prominent companies have been releasing their quarterly results. Now, these results are very important because they give us a glimpse not just into individual performances of companies, but also into broader industry trends that might really be relevant for you and me as investors or for people who track the markets. Now, one sector here that almost always ends up drawing attention is the FMCG space. Now, this is because the sector deals with products that you and I as consumers buy and use almost on a daily basis. And the space has been particularly interesting and exciting right now because the Indian FMCG space is going through some major transformations and some major shifts. There are concerns about rising raw material costs, consumption patterns of people are evolving very quickly, and e-commerce has grown very rapidly, which has largely started to reshape this age-old industry. Now, at its very core, FMCG is a volume-driven business. Companies end up prospering by producing at scale, building strong distribution networks, and also leveraging their brand power. Historically speaking, FMCG has been a bit like a defensive sector. It has been relatively stable even during economic downturns because people still continue spending on essentials like food and basic personal care even when the economic situations are not really good enough to spend much on other things. But beyond all of this, there is one more reason why the FMCG industry is very interesting. See, there are parts of India where this industry has matured, which is where brands are well established and markets have been saturated. But there are other parts of India where FMCG companies are still in the process of penetrating. And that growing part of the FMCG business is particularly susceptible to factors like how quickly the economy is growing and how confident customers are about their future spending habits. Also, considering all of this, the FMCG sector has historically grown in the range of 7 to 9% per year. Now let's come to what is happening right now. See, the FMCG industry is currently facing 3 big challenges that I will deep dive into today. First is that urban consumption has been fairly sluggish. And this matters a lot because almost 65% of FMCG demand comes from urban areas itself. But very interestingly, people in rural areas have now picked up some of this slack. In fact, rural demand has grown faster than urban demand for 4 quarters in a row now. Second, FMCG companies have been seeing their margins shrink. See, inflation is high and the cost of inputs like palm oil, coffee, tea, etc. are going fairly up. Now, this threatens the profitability of FMCG majors even if their volume demand keeps going up. Third, distribution channels are changing very rapidly. See, the traditional way of selling products in India, which was through kirana stores and bigger department stores, is now being challenged by the rapid rise of online shopping. With e-commerce growing at over 26% every year, these companies are now having to change their usual methods of getting products to buyers, and that is causing a bit of a stir in the industry. Now, over the past few days, 5 major FMCG companies have reported how they performed in the latest quarter. HUL or Hindustan Unilever Limited, Dabur, Nestlé, Marico and Tata Consumer Products. And looking at their specific numbers actually help us understand how these big shifts in the market have really played out for each of them. So let me begin with HUL or Hindustan Unilever Limited. See, HUL did not see much growth this quarter. Its revenue rose 1.4% year over year, but its profit after tax or PAT remained fairly flat. Its gross margins shrank by about 83 basis points year over year as inputs grew more expensive, but it adjusted that drop by spending less on advertising. And its operating margin as a result of all of that stayed fairly the same. Both revenue and profit after tax fell quarter on quarter by 0.6% and 3% respectively though. Moving on to Dabur, Dabur saw some muted growth in this quarter. Its revenue grew by 3.1% year over year, while profit after tax grew by 1.5%. But that said, this quarter was much better for the company than the previous one. Quarter on quarter revenues grew by 10.8%, while its net profit was up 23.5%. Inflation cut into its gross margins, which fell by 55 basis points year over year. Operating margins though stayed in a stable range of 19 to 20%. Then there is Nestlé, which saw some growth in sales this quarter. Their net sales went up 3.9% year over year, but their margins took a bit of a hit this time. Gross margins were down 2.2% due to rising prices in cocoa, coffee, and edible oil, while its EBITDA margins was down 1.05% year over year. And as a result, its EBITDA shrank slightly by 0.6% year over year, but quarter on quarter, its net sales fell 6.2%, while profit after tax remained fairly flat. With that, let's move on to Marico. See, Marico saw its net sales jump by 12.4% year over year, with domestic volumes growing by 6%. Its margins took a hit though. Gross margins fell by around 1.8% year over year, which was driven by an increase in copra prices, and its EBITDA margin shrank by 2.1%. And as a result of that, its profit after tax, or PAT, grew by 4% over the same quarter last year. And also, this quarter was slightly better than the second quarter of FY 2025. Net sales went up by 2.5% Q on Q, while PAT went up 3.2%. Then finally, let's move on to Tata Consumer Products. Now, this one is a little hard to measure because this company has recently acquired some businesses which eventually end up skewing its results. But either way, year on year, its revenues grew by about 17%, but only 9% of it was organic. The rest of it came actually from its acquisitions. Its profit after tax adjusted for these acquisitions fell significantly year over year by 11%. You'll also see very similar dynamics quarter on quarter, where revenues went up 5.4% while its profit after tax shrank by 7.6%. Its gross margins took a severe hit over this FY of 2.73% year over year, while its operating margins were hit by 2.34% year over year, to a great extent because tea prices went up. Now, of course, this was a very high-level analysis of the sector. But the thing is, if you look a little deeper into everything that has happened, we can actually spot a few additional and a few important themes. First, we can see that companies are now finding it hard to push sales in cities. While the overall demand in urban areas has been fairly slow, rural areas have surprisingly stepped up and grown faster. Some reports also suggest that there is fierce competition amongst major brands, especially online, which is driving them to lower prices or offer deals in order to grab customers. Next, there is rising premiumization. In very simple words, people are now increasingly choosing to buy costlier and high quality products than they were ever doing before. And the interesting bit is that even though the general demand has been weaker, premium products are still doing fairly okay. And companies are also making moves in this direction. For example, HUL has recently made moves into this space by acquiring skincare brand Minimalist. But that said, there are also some exceptions here. Tata Consumer Product is one such example in tea, where some shoppers have actually switched to cheaper varieties in that case. Meanwhile, there's also another interesting insight where people are now choosing smaller packet sizes because they don't really want to commit to a large pack size unless it is absolutely necessary. And on top of all of this, raw material inflation is also really cutting into profits. Milk prices, for example, have risen by about 20% since 2020, and cocoa prices have doubled in less than a decade. So now FMCG companies are having to explore different ways in order to manage their costs. Some are increasing prices by a bit, the others are trying to buy raw materials more smartly, and some others are cutting down on certain expenses, including advertising costs. Finally, e-commerce is also growing at a rapid pace like I mentioned earlier, and this is forcing FMCG companies, who usually end up relying on their strong networks of local shops, in order to rethink how to sell their products to people like you and me. Nestlé, for example, has seen its online sales jump 33% in the first 9 months of the year compared to last year. Marico's e-commerce sales have also gone up quite a bit, by 50% in the same time period. And because of all of this, many companies are now investing in brands that live mostly online, like Marico's Beardo or HUL's Minimalist. And the hope here is to tap into the rising preference from shopping from home, or online for that matter. So basically, all of these changes put together show that the FMCG industry in India is in a phase of rapid evolution right now. It has not really lost its reputation of being stable like I mentioned earlier, because essential items will always be bought by consumers. But the thing is, it is definitely feeling the strain of shifting consumer preferences, higher costs, and a new wave of competition that comes from the growth of e-commerce and quick commerce. Now, this sector will continue to watch out for two main things in the coming months ahead. One is whether urban dwellers will start spending more money, and the other one is how companies will handle the challenge of high raw material costs and changing distribution channels. With that, let's move on to the second story of the day. See, there's currently a major dispute going on between Volkswagen and India's revenue department. And the thing is, it seems to be getting a little messy as time goes by. Now, this issue started in September 2024 when Indian tax authorities handed Volkswagen a massive tax notice of 1.4 billion US dollars. They accused the company of underpaying import taxes for many years. Now, it all comes down to how Volkswagen brings car parts into India and then assembles them locally. But first, before we get into the details of the story, let's quickly understand the tax rules in India when it comes to importing car parts. See, if an automaker brings a car into the country in what's called a CKD form, where the main parts are sent together, almost like a self-assembly furniture kit, then the importer is charged a much higher tax rate, usually around 30 to 35%. Now, this is because in that form, the car is considered nearly complete and needs only minimal work once it is in India. But if the company imports individual parts separately, like engines, axles, body panels, etc., the tax rate is usually lower, usually in the range of 5 to 15%. Now, the logic here, as you might have figured, is that when parts are shipped separately, it suggests that there might be more local manufacturing or assembly work happening, which India wants to encourage in the first place. But the problem is that Indian authorities believe Volkswagen has been splitting up their shipments to make it look like the parts are unrelated, when in actual reality, they are parts of a complete car. They are saying that Volkswagen is doing this deliberately in order to benefit from the lower tax bracket here. According to the government, anywhere between 700 to 1,500 parts per car are being imported, sometimes in separate batches instead of being shipped together as a full kit. Now, Volkswagen, of course, very strongly disagrees with this acquisition. They insist that they have only been importing parts separately for logistical reasons. In other words, it is more convenient to bring them in separate batches rather than bringing them all together for tax purposes. They also claim that they've never bought in fully assembled kits or something that is close to it also. And in order to illustrate this a little better for you to understand, they use the example of buying a disassembled chair on a shopping website. If it arrives with all the pieces in one box, that's basically a single kit and it is taxed more. But if each part is shipped on a different day, it is not really considered a kit anymore. It is just separate items. Now, Volkswagen says that that is exactly what is happening with their car parts and there is nothing illegal about it whatsoever. And adding to this entire confusion, Volkswagen says that it made its part-by-part strategy very clear to the Indian government as far back as 2011, and at that time, it was apparently told that everything was in line with the rules. And therefore, according to Volkswagen, over 1 decade later, Indian authorities seem to have changed their view, and Volkswagen is calling this a sudden and unfair reversal. According to them, this kind of unexpected shift in policy threatens trust in India's business environment altogether. The company even described the tax demand as a blow to India's ease of doing business reputation, and they are warning that these unpleasant surprises could make global investors think twice about entering or even expanding in our country. Also, by the way, Volkswagen is very heavily invested in India right now. They run their operations under Skoda Auto Volkswagen India Private Limited, which handles several well-known brands like Volkswagen, Skoda, Audi, Porsche, Lamborghini, etc. It has already committed a huge sum of around 1 billion euros to develop cars which are tailored to Indian consumers. The Volkswagen Tiguan and the Skoda Kushaq are products of this exact plan, and Volkswagen has also merged their local operations under a single umbrella so that it can produce more vehicles efficiently. But still, despite all of this investment, Volkswagen's share in the Indian car market is barely about 2%. In the last financial year, the company made sales worth over 2.19 billion US dollars, but its profit was only around $11 million. So therefore, a looming tax bill of 1.4 billion US dollars could really derail its future plans almost entirely. Now, very unfortunately, this kind of a scenario is not at all new for foreign companies in India. And when it comes to all of this, people usually end up recalling the Vodafone tax dispute, which started when Vodafone bought a stake in an Indian telecom company through an offshore deal. At that time, the Indian government had imposed a massive capital gains tax on Vodafone, even though this transaction took place outside India. The Supreme Court eventually ended up siding with Vodafone in 2012, but rather than giving up, the government actually changed the tax law retroactively to make Vodafone pay that amount of money. Now, this move caused a global uproar of sorts, and it wasn't until many years later that the government finally scrapped this retroactive tax. But the sad reality is that by then, Vodafone had already suffered huge financial damage, which many people say affected its long-term health in India. And it's not just this, there are other examples as well. Nissan, for example, got stuck in a tax dispute over unpaid incentives that it said the Tamil Nadu state government had promised. Ford also decided to exit India after years of losses and various challenges. Also, Tesla, which is one of the most talked about car companies in the entire world, has kept putting off its India entry because of the high import taxes on electric cars. So, all of these incidents raise questions about how inviting India is truly for international businesses, despite things like Make in India and promises of a more open marketplace. Also, by the way, in Volkswagen's case, this dispute has already had some real consequences. After the tax notice was issued, customs authorities briefly held up more than 50 shipments of spare parts for Volkswagen's luxury brands, including Audi and Porsche, at a port in Mumbai. Some dealerships were left waiting for crucial components, and it caused disruptions in Volkswagen's supply chain. Although the shipments were let through eventually, the delay was a very serious warning that this situation could get much worse if this dispute is not resolved soon. Volkswagen has now gone to the Bombay High Court to challenge the $1.4 billion tax notice. There is a court hearing scheduled on 5th of February, and Volkswagen wants the court to cancel the tax demand so that it can focus on its long-term plans in India without this huge cloud hanging over its head. But this outcome has implications beyond just Volkswagen. India wants to be seen as a global manufacturing hub, and how this case is handled might either boost or even damage our reputation. Some people are worried that this could also turn into another Vodafone moment of sorts, and that might drive foreign investors a little more away from our country. But the others hope that it is a fair resolution which will reassure companies that India is really committed to supporting international businesses. But either way, we do not know for sure who's at fault here, so it's very difficult to form a very fair judgment here. But either way, everything hinges on the legal proceedings now, and the world is definitely watching. So those were the two stories of the day. Now let's move on to the final section of the day, which is the quick news headlines. First, India's Manufacturing Purchasing Managers Index, or PMI, climbed to 57.7 in January 2025, up from 56.4 in December 2024, marking its highest level in the last 6 months. This strong expansion was driven by a surge in export orders, which is the sharpest in nearly 14 years and the fastest rise in domestic orders since July 2024. Second, Allied Blenders and Distillers, or ABD, which is the company behind Officer's Choice Whiskey, is set to introduce 3 new luxury brands as it pushes deeper into the premium alcohol market. Currently, luxury spirits make up just 3% of ABD's total sales volume, but they contribute over 20% to the industry's profits, which highlights the high margin potential of this segment. Third, India's advertising industry is projected to grow by 6.5% in 2025, reaching 1.1 lakh crore rupees. Digital advertising will drive this growth largely, accounting for about 49% of the total ad spends. Meanwhile, TV's share will drop to 28% and print share will shrink to 17%. That's all the news and stories I have for you today. I hope you enjoyed this episode and maybe learned something new from it. This is your host Anurag Bansal signing off. I will see you in the next episode. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.